Ladies and gentlemen, please join me in welcoming Tony Alexander.
Rightio. Look, thanks very much for that, Kenina, and thanks everybody for coming along this evening. I'd like to thank the sponsors there. Pathfinder, I've bought one of the vehicles you make in conjunction with Nissan. Last year was something I shouted myself. I've been at this venue at least 2 times before. I think the most recent time might have been with the bank 3 or 4 or 5 years ago. First time might have been 15 or so years ago, and I remember the balloons. There were hot air balloons flying around out there, so I'm just a wee bit concerned if they show up again. Is that normal, that you have this aircraft noise sort of coming across so low there? Not quite used to that. Any aircraft pass above me in Wellington. I live on a 10-acre block there. They're quite a ways up in the sky there. Now, I've got a presence here in Auckland. I've got a wee apartment I bought about 5 years ago. It wasn't an apartment at the time. It was a disused cocktail bar. And so I went and bought that, and it took about 4 weeks with the council to get it reclassified, resource consent as an apartment. So I've got a bit of an exposure to the Auckland property market. It doesn't make me an Aucklander, is definitely what I say and what you should say when you go to other parts of the country, I would suggest, as well. I'm born and bred in Christchurch. And in fact also have a little bit of land down there, and like I say, I actually live in Porirua City, just north of Wellington. But what it means is that I can actually slag off a lot of the country and sort of get away with it, in that I'm sort of a local in many places. Now, that doesn't mean I've got anything nasty to say about Auckland, but it is interesting when you get out to the rest of the country there. It is one of the public speaking things. If you're from Auckland, make a joke about yourself sort of straight away, and they'll love you there in Ekatahuna or Riverton or wherever you've popped yourself up. Now, I'm going to be speaking up here for about an hour, so that's taken us through to, I'm assuming there, that's about 6:30. And what I'm going to do is I'm going to start thinking about what I was talking about before COVID came along. What I mean by that is that 2 hours ago, I found myself sitting at the table there. I showed up early because of the traffic issues. And I found myself flicking back to some of my speech notes there from earlier in this year, because some of the stuff is starting to become relevant again. And I would suggest for yourselves also, you need to be re-engaging with some of the strategic planning and long-term considerations you were thinking about before we had heard about this COVID-19 situation, and especially when it comes to the labour market and labour supply. The biggest problem for many businesses heading into all of this was you couldn't find people to work in your business. Years ago, you hired all the motivated, skilled people, and then the unmotivated, skilled people, and then the motivated, unskilled people, and then the unmotivated, unskilled people. And about 5 years ago, you hired all the dope smokers out there, and now you've been actively looking for pee takers, because if the dope smokers are slow, and I think pee takers move fast and shake like this, there's probably a blend you could mix within your factory floor or within your business and have everything work out okay. Labour supply was very, very restricted, and this is coming back with an absolute vengeance. So just be very careful if you've still got in your mind a view that the unemployment rate is still going to go to the 11% or 15% that some extreme pessimists were forecasting back over March, April and May. The market is tightening up fairly aggressively at the moment, and businesses, I've spoken with a number of them, they've gone back to people they laid off 3 months ago and saying, look, I've got your old job here, you want to come back in, can you start on Monday? And they've already got jobs somewhere else. So that's one of the things that's sort of been happening, let's say, just over the past 3 months. There's been a lot of stuff happening out there that has taken a little bit of a while maybe to break through into the anecdotes and into the general discussion. The other one, of course, is the housing market, the house prices going through the roof, and we learnt just this morning that average house prices around New Zealand and in Auckland rose by 3.5% in just the month. There definitely is a feeding frenzy going on out there, and of course this is something that nobody of any sane disposition was expecting when we saw the economy falling away, shrinking by 12.2% over the June quarter. And I'm going to spend a bit of time talking about why the housing market has been so strong. And at my maximum, I got a list of 25 reasons why house prices are rising so strongly. And if you're interested, just go into my extremely basic website, tonyalexander.nz. Don't get excited thinking you're going to get lots of rapidly updated news items or anything there. It's basically just a signpost to say, I still exist. Here's a link you can click on and you can get my free weekly Tony's View publication if you like. And the Tony's View Weekly from September 17 contains the list of 25 reasons why house prices are rising. And I'm going to run through a few of those things here. But what really gets me excited sort of at the moment, and it's been building over the past few weeks, is not being able to return to some of the key themes I was speaking about at functions like this ahead of COVID, or not being right on the housing market. None of us have been right on the housing market, but being, I would suggest, least wrong of the analysts out there. What's got me pretty interested is what's happening now when it comes to residential construction, because so many people can't buy a place. The listings out there of property, there's a lot of attention being paid to the fact that the number of listings is about 20% lower than a year earlier. That's nothing. Listing numbers are down 66% from 10 years ago. There has been a structural tightening up of the availability of second-hand property available for sale out there, and it's not going back the way it was previously. And so a heck of a great number of frustrated buyers have now, over the past 2 to 3 months, been going to builders in order to get places to be built. And this is exceedingly positive for the economy. Because if you go back to the old days of Muldoon and the likes back then, if you were looking to stimulate your economy ahead of a general election, you would do something focused on residential construction. Because what happens is that you not only get extra activity on the building site itself, your drain layers, the plumbers, electricians, carpenters, etc. There's all the manufacturers of the building materials, the timber mills making roofing materials, the plumbing equipment, etc. There's the council inspecting surveys. There's the civil engineers with all the infrastructure, the subdivision layouts, etc. Architectural services. House building has a uniquely large multiplier impact across the country, and it is countrywide, and it affects thousands, literally tens of thousands of small businesses, contractors all around the country. And so in that regard, you're seeing stuff at the moment from the Reserve Bank looking to maybe try and dampen down a certain number of things out there. Be in no doubt that they will be happy that house prices are rising. I'm not saying they're happy at a 3.5% gain in 1 month, but they're definitely happy that they're going up, because that is leading to a reasonably strong economic stimulus for our economy over the next few years. And this is going to provide a huge challenge for the government. And this is a warning to yourself that if, when the lockdown sort of came along and the government starts talking about we're going to boost the economy with shovel-ready infrastructure projects, I'm still waiting to see the list. If you happen to submit a whole lot of shovel-ready projects, don't get too optimistic about them getting done in the very near future. The reason is, for every person that gets hired to do some shovel-ready road or bridge or little tunnel or whatever over there, that's probably one less person to go building houses over there. And we know that the government is legitimately, most people are, concerned about the shortage of houses in New Zealand. So if they try and drive forward with this non-residential construction, civil engineering stuff, not as many houses as would otherwise be the case will get built. And so unless this government, a Labor government, is prepared to say, we want to get both done, therefore we have got to let in an extra 50,000 migrants coming in from the Philippines or where else, and, to work on the building sites there, you're not going to get both of these things done. Because what's happening in the economy is we are moving back again, not quite there, to being a capacity-constrained economy. And I'll speak about that later on, because that was one of my key themes before all of this came along. Like I say, you can go to the website if you want to sign up to the free Tony's View there. For me, the virus has been quite good in terms of, I can't remember what I was thinking about on December 31. I was aware of something happening in China, and I'm claiming, until somebody tells me I'm wrong, to be the first person in New Zealand to have actually written that something was happening in my first weekly for the year on January 9th. I said, right, looking at the year ahead, looks like it's going to be okay, but there are two things to keep an eye on. Number one, the Americans have just assassinated an Iranian general, and that seems like the sort of thing which could lead to disturbance in the Middle East, something like that. And I said the second thing is we're getting reports out of China of some new virus, influenza or whatever, sloshing around, and maybe that would be a thing to keep an eye on. So I've got to restrain myself for my first publication for January in a couple of months' time not to say, and I was looking through an astronomer magazine there and they made mention of an asteroid that might come quite close to the planet in the very near future. Wouldn't like to have an established record in that regard. If you've got any questions along the way, go for it. I'm doing these sort of presentations all the time. I could stand up here for 3 hours. I did 2.5 hours once in Martinborough there about 4 years ago, but I'm not going to do that. But if there's a little tangent you want me to shoot off onto, I'm more than willing to do that. I'll leave time for questions at the end, and then I'll be sticking around until the cab shows up at about 7:30 as well, if you want to have a wee one-on-one there later on. So let's just get stuck into it. In terms of the economy is performing far better than any of us were expecting. I'm going to start out by focusing on a list of stuff that I was talking about pretty much from back in March of this year. When the COVID-19 crisis came along, I had exactly the same level of knowledge about what it would do to our economy and the world economy as the entirety of the economic staff at the Federal Reserve in the United States, and same as all the Reserve Bank economists here in New Zealand, Treasury or whatever. None of us were able to go into this and say what usually happens when we have a global pandemic is this, and what usually happens when we have a lockdown is this. We had not the foggiest idea. And so I thought to myself, well, okay, if I haven't got the foggiest idea, and I know they haven't got the foggiest idea, why are they going for the most negative scenario? Because that's pretty much the bulk of the forecast that you saw coming out was the economy's going to be stuffed, we're well munted, the unemployment rate is going to rise to easily above 11% was the forecast from one major bank there in the country. They figured the economy would fall 20% in the first half of the year, and they figured house prices would fall by over 15%. Well, house prices fell by 3% over a quick 2-month period in April and May and have risen about 10% since then. The economy only shrank by 13.5% or so in the first half of the year, and the September quarter unemployment rate wasn't over 11%, it was only 5.3%. And in case you missed the detail, yesterday the Reserve Bank predicted that the peak in the unemployment rate will be 6.4% early next year. Things have really turned around on a dime, and what I decided to do right from the start was not say, no, we're not going to have a deep downturn, because pretty clearly with a lot of businesses unable to operate, the foreign tourists unable to come into New Zealand, our economy was going to take a big hit. I decided to focus instead on factors which would help insulate our economy, factors which wouldn't stop the downturn but would mitigate the downturn and would set the scene maybe for improved activity further on out. And I would run through this list in numerous webinars and writings, etc., and advise businesses that, you know, definitely you slim yourself down, but try your best not to close down and pull back on all your advertising and branding, because there is going to be light at the end of the tunnel, and you want to get yourself set for that when it's eventually going to come along. And that is the moving beastie on the planet right at the moment. Light at the end of the tunnel for every economy around the world, most businesses, most sectors, etc., as a result of Pfizer's announcement of an intermediate 90% success rate for their vaccine. Now people are leaping forward to the borders are opening again, the international tourists are flowing, we're not going to have any more downturns, and that is absolutely vital in the world, not just of investments, share prices rise, this sort of thing, but when it comes to businesses re-engaging with their pre-COVID investment plans. Because what happens when you have a bad thing come along, you as business people, you pull back on your capital expenditure. You know you need to introduce labour-saving technology, you need modern computer systems, a better layout or location for the factory, distribution sector, etc. But when this comes along, you lose your confidence, and so naturally you pull back on your capital spending. Now around the world, businesses will be stepping forward again and looking to advance their original capital spending plans. And that also is vitally important for a whole range of small, medium-sized businesses and contractors around the country. Someone's got to import, ship around the country, the new machinery, install it, test it, undertake extra maintenance to catch up on stuff or whatever. The capital expenditure cycle in an economy It aggravates a downturn when you don't build the factory. It accentuates the upturn when you catch back up on it. Some of the insulating factors that I've focused on, and coincidentally I also maxed out at 25 of these, and if you do want that list, it's in the October 1 Tony's View weekly publication. Here's a few that I pointed out right from the start. It's the case, yes, that foreigners coming into New Zealand would spend about $17 billion. That's about 5.5% the size of our economy. So yeah, that is where we get our biggest hit on economic activity. We no longer have all these foreign tourists buzzing around the country. Obviously bad news for your prime tourism destinations, etc. But we Kiwis, we spend $10 billion overseas, about 3.3% size of our economy. And I said right from the start, just watch out for us Kiwis. We've got $10 billion we'd either physically already set aside or had sort of allocated in our heads for that spending overseas. We're not going to do it. I wonder where it is we're going to spend it. Well, we've spent it on just about everything over these past few months, including into the housing market. We have spent it on, in particular, durable consumer goods. So this also is a classic thing that when an economy slows down and people are worried about things, you and I, we might need a new car or a new couch, but we don't necessarily need it right now. We can choose the timing. When time is good, we buy one. When we're worried about things, we will not buy it. We'll plan to buy it 12, 18 months down the track. So what normally happens when a recession comes along is you see plummeting sales of spas, of TVs, of gazebos, not sales rising now to 3 times what they were a year ago. We've taken our $10 billion and we've upgraded our houses after 7 weeks at looking at the dusty old walls, etc. We've knocked out walls, put new ones in for home offices, etc. And you have got completely the opposite of what normally happens in a recession for so many retailing sectors out there, and I guess the distributors and the manufacturers of those retail materials here in New Zealand, but also in China. China's factories are going gangbusters because someone is making the spas and the couches and the kit set gazebos or whatever. The Chinese economy is growing relatively strongly. But that's the first key thing here, $10 billion that you and I are spending, and maybe there's 2 to 3 quarters, 3-month period, of that left. There's a point next year where you will stop doing that sort of spending and you will start allocating the money again for travelling overseas. I know you're going to do it because I have set up for my with my little activities here 4 monthly surveys. And the big one is, I usually get about 1,500 responses on that. I ask the likes of yourselves, are you looking at spending more or less in the next 3 to 6 months? And right from the start, the first survey I did in May, a high proportion of you were saying, I'm going to spend some more in the near future. And I gave different categories of what you could spend on, and it stuck out right from the start. You were going to spend more on home renovations, on domestic travel. In the second survey, I split the travel category into international and domestic, a bit of a miss on the first one, and gardening as well. These ones have stuck out very, very strongly. And maybe I'd have an extra question at the end. So for the survey I sent out about a week and a half ago, I said to the people bothering to answer it, are you looking at travelling overseas again when the border's fully open within 6 months, 6 to 12 months, 12 months and a bit after that, or really not at all? It was roughly an even 25% split for every category. In other words, about half of respondents saying, I'm out of here in the first 12 months, I'm going to be travelling. So I didn't say shifting overseas, it's about travelling overseas. So that's going to be good activity coming forward eventually from maybe the middle of next year for outward tour, travel agents, that sort of thing. I asked the question though to try and get a feel for, but when the borders open, will the foreigners come back again? I look at those results and it says to me, I think yes, they will be coming back again. Of relevance here is that, like I say, I think from maybe the middle of next year, we will pull back on buying these spas and this sort of thing. Now, that doesn't mean that if you're looking at setting up in the spa, gazebo, or whatever business at the moment, you don't do it. It just means you need to anticipate that if sales are 3 times normal at the moment, there's a payback. The durable cycle is upside down. By all means, buy the business, purchase the new franchise or whatever, but base it on sales revenue over 2018 and 2019. For God's sakes, do not use this year. You will end up paying a heck of a lot too much for that particular business there. Other insulating factor, 7 weeks of not spending during lockdown. We built up a lot of savings over that period of time. And this is particularly interesting, I'd suggest, when it comes to the first home buyers, that as soon as lockdown ended, they jumped holus bolus into the housing market. Not the investors, it was the first home buyers that jumped in there. And I guess what they saw was that, geez, that bloke was right. When back in 2016 I wrote, if you want to save up a house deposit, maybe you need to spend as much as your parents and grandparents did on eating out, on travelling to the GC and Fiji and Paris, etc., on new clothing and new footwear and going down to the bars and the restaurants, etc. And the snowflakes, they don't like it when I wrote that. In about April 2016, a man got into a little bit of trouble. Maybe I got into trouble because I also said, hey, look, buy an old dunga and do it up, or buy a meth house. And I said that because the meth houses were selling for about $100,000 cheaper than other places at the time. And within about 6 months, the government's chief science officer came out and said, a version of, you could let your baby lick the walls of your meth house all day, and as long as it's not in the bake-up room, your baby's not going to get sick. The standards are wrong. And they changed the standards, and instant $100,000 capital gain for anybody who did purchase that. So I got into a wee bit of trouble maybe for writing about the meth house back at the time, but what are you going to do? I'm claiming to be inaccurate on that one. The young people saw what could happen if you do actually forego some of that regular spending. They built up some higher deposits, they took the 25 grand they were going to allocate maybe on overseas travel or whatever, and so they found themselves with some extra money available to jump into the housing market when it opened up. I'll come back to that specifically later on. A few other insulating factors there. A big one, of course, is interest rates. Now this one is relevant in three. A few days ago I was saying maybe 4 ways, but we'll take 3 ways. Number one, interest rates were cut last year by the Reserve Bank. They were worried about a collapse in business sentiment, a new winter of discontent over the Labor government in the middle of last year, and they cut their cash rate 0.75% between May and August last year. That was significant because it happened at the same time as we got confirmation of no capital gains tax in New Zealand, no collapse in migration that people would have been thinking about over 2018, no obvious negative impact on the housing market from the ban on foreign buyers from October 2018, and the interest rate cuts basically reignited what had been a slowly easing off housing market outside of Auckland. It strengthened in December and March quarter last year, March quarter this year, but also it acted as the trigger for Auckland to end its 3 years or so of lying fallow, of prices not going anywhere. Auckland was sort of due to kick back up on the upward leg of its house price cycle, and it started on that in the December quarter of last year, and it continued in it through the March quarter of this year as well. So we went into this already with record low mortgage rates and record low term deposit rates, just nibbling away at the willingness of investors to leave money there and not invest in other things. That's the first relevance of low interest rates here. Secondly, the Reserve Bank cut, logically, by another 0.75% in March. The mortgage rates go even lower, the term deposit rates go even lower. For a while, there was an expectation, from about June or so, that the Reserve Bank would take the official cash rate maybe negative next year. I was always dubious, and now I don't think they're going to do it in light of the evidence of the economy improving relatively strongly. But I used to whack that in there in terms of, and you expect interest rates to go even lower and make housing more affordable, that sort of thing. But the fourth key one here, or now it's down to the third one, is that interest rates are going to remain low for a number of years. The reserve banks around the world, the central banks have said it, we expect it, and that is relevant if you're an investor there and you're approaching retirement and you were thinking about selling your investment property and you were going to have a low risk portfolio, lots of money sitting in the bank earning 4 to 6% on term deposits. I have no idea what year, what decade you'll see interest rates like that ever again, quite frankly. And so you are now going, I will not sell my property that I bought 10, 20, 30 years ago in response to government saying your retirement is going to be rubbish, national superannuation might disappear, maybe you need to build up an investment portfolio. Remember, from 30 years ago, governments were actively campaigning people to save more and invest more. And those campaigns, they struck a bit after the 87 share market crash. And so when people rag on baby boomers for owning property, their most recent memory when they were receiving advice to invest and save more was shares. That seems like a relatively dangerous thing to invest in after the 87 crash, and they gravitated themselves towards property. So the interest rate dynamic is very, very strong in this regard. And that's obviously of high relevance to the housing market, not really to business investment. Interest rates really don't matter when it comes to business capital expenditure. It's confidence in the economy going forward. That's 90% of the story in terms of whether businesses invest or not. The interest rate thing, it's only a little bit of an element at the side. A few other things to think about there. We went into this without a great level of risky lending into the home sector, in that from 2013 we had LVRs in place, initially at 20% for everybody. 2015 they were strengthened with a 30% minimum deposit in Auckland. 2016 for investors. 2016 it was a 40% minimum deposit for all investors all around New Zealand. We went into this without greatly risky lending. The banks, you'd go to them and they might lend to you at 5.5%, but they were working out your ability to afford that debt at 8.5% or 9%. The test interest rates, the applied interest rates, were very, very high. And the actual rate of growth in household debt ahead of the global financial crisis, household debt in 5 years leading into it grew by about 80%. 5 years leading into this, only about 40%. Same for businesses, about 80, 85% and 40%. Leading into the GFC, farm sector debt grew 111% in New Zealand. It only grew 20% leading into this. We did not go into this with highly geared private sector in New Zealand, be it business, farming, or in the on the housing side. So that's another relevant factor. Another key thing I emphasised was that if we have a recession in New Zealand, it usually is caused by we're growing well, wages pick up, businesses increase their selling prices, inflation goes up, the Reserve Bank raises interest rates. We initially really don't care because we got a job and house prices rising. They keep pushing up interest rates. The currency goes through the roof. The farmers get absolutely screwed, along with the manufacturing exporters. The construction sector is badly affected by the interest rates going high, a few fall over, etc. And what you get is the recession being felt most strongly and initially in the goods-producing sectors, sort of the hard jobs part of the economy. This one is the exact opposite. The burden of the unemployment is borne predominantly by the tourism sector. Tourism, hospitality, retailing, entertainment. Sectors where the bulk of the employees tend to be young and they're on below average and variable wages, and they don't own houses. The farmers, the factory workers, etc., these people tend to own houses. But the younger people working in these service sectors that have taken the brunt of the unemployment in New Zealand, they don't own houses. Hence, no wave of unwilling sellers, no wave of mortgagee sales coming through. Hence, me zero worry about what's going to happen when the mortgage deferrals run off, in a few months' time. It's completely irrelevant, quite frankly. But that's another insulating factor. Absence of mortgagee sales, absence of that usual recession downward pressure on the house prices. And then there's another one I'll finish up with here, and we've had a migration boom. Now, right from the start, when everybody's talking about this migration, they're saying, did you know on average for the past few years, we usually get a net migration gain per month for New Zealand of around about 4,000 people. And once the borders close, late March, there will be no plus 4,000, plus 48,000 people per annum. Oh, that's going to be really bad for the housing market. The price is going to fall away, and that's going to be really bad for the rental market. These people aren't going to be around, and it's going to be bad for the economy generally, and therefore you're all stuffed, basically, was the signal from many forecasters back at the time. And what I pointed out was that, well, hang on, these numbers were actually starting to strengthen again before the lockdown came along, and from the middle of last year, no virus involvement at all, the numbers of Kiwis leaving the country was coming down, the number of Kiwis overseas coming back was going up, and we finished 2019 with something we've never seen before in New Zealand, a net annual migration gain to us from Kiwis. Normally, it's a loss of an average 20,000 per annum since that particular series starts in 2001. This was already happening before COVID came along. And in fact, even in the 3 or 4 years leading into the middle of last year, the net annual outflow of Kiwis was only around 6,000 or so. There's been a structural shift, and I used to talk a lot about a different version of this over a 40-year period I might come back to later on. We keep getting revised numbers from Stats New Zealand, and we got them earlier on this morning. In the 12 months to March, the lockdown, we had a net migration gain for New Zealand of 95,000 people. It's almost 2% boost to our population. Now, that is why you're seeing people queuing for rentals and the rents going up, because we already had in New Zealand at the time of lockdown, and still have now, the net migration gain that people like me expected would eventually accrue bit by bit each month by October next year. All of that gain we expected, those people were already in the country in March. Hence, there is a shortage of rental property. If this was just some speculative, maybe interest rate driven phase of increasing house prices, there'd be a lot of empty rentals. Who's last heard about Airbnbs sitting out there unused and collapsing in price? Queenstown prices, for your guide, are now up 0.3% on a year earlier for their prices. A lot of people are going to be thinking, well, hang on, the students come back and this sort of thing. Maybe there's some canny purchasing in the Auckland inner city, apartment market that obviously took a big hit from that. But that population dynamic, it is fully accurate to say that when the borders closed, the net migration flow, it fell away to about zero. Actually, in the 6 months data we have since the border closed, there was a net migration gain of 2,500 people, so that works out at 5,000 for the year, but it's increasing. Each month it seems to be just oscillating upward, meaning that maybe in 6 months' time, even with the borders still being closed, we're not looking at the plus 880, I think it was, for the month of September. Maybe it's up to something like plus 2,000. Why the hell would somebody leave the country to go overseas when they're seeing the worsening infection rates and the lockdowns re-emerging overseas, and the world looks, obviously favourably at New Zealand? We've got all these queues of Kiwis hoping to get in to the country. So I just wonder, the net monthly migration numbers, I actually think, are going to be trending up again, even with the borders closed, quite frankly. Like I say, there's a lot of other factors that I could mention there, but it adds up to, there was a lot of supporting factors for limiting the extent of downturn in our economy and for helping now drive the economy up at a faster rate than any of us, even glass half full me, ever thought would be possible over the second half of this year. The Reserve Bank yesterday estimated that after shrinking 12.2% during the June quarter, our economy, it probably grew over 13% in the September quarter. And there's a whole range of indicators that I could run through, basically showing how things are improving out there. And maybe one of the ones I'll refer to also comes from the survey, the Spending Plans monthly survey that I run, that I mentioned early on. I said sort of right from the start it was a positive number, saying to me, hang on, people are going to go out there and spend. And the most recent observations or outcomes would be, so this would be 2 months ago, September, a net 13% of you said, I'm going to spend more money the next 3 to 6 months. Then 1 month ago, October, a net 32% of you said, I'm going to spend more. And my most recent survey from about a week and a half ago, a net 37% of you said, I'm going to spend more in the next 3 to 6 months. There is still spending of money, there is still catch-up spending, there is still hefty evidence of spending of money that was going to be spent overseas out there. It is going to be a strong Christmas and summer period for the bulk of retailers out there. It's just going to be a problem in that a lot of them are not going to have the stock. With often less than 1 week's notice, you're expecting your goods to come in, but the ship isn't coming to New Zealand. Maybe if you're lucky, they might unload your goods across in Brisbane, Sydney or Melbourne, and then you've got extra freight charges maybe to try and get them across from there. But the shipping logistics are actually a bit of a problem on the importing side coming into New Zealand. Not the exporting of the bulk commodities, which is still largely what we ship overseas. The government's subsidising each Air New Zealand flight, I think $87,000 to be flying around there internationally, so there is still some ability to get some sort of freight there in the aircraft cargo hold. But certainly for some exporters, the lack of the great number of flights is definitely a problem in getting some of their goods overseas. A few other indicators here, and this one bespeaks of what I sort of started out with about the labour market tightening up rapidly. The NZIER, New Zealand Institute of Economic Research, they've got a survey that's been going since the late 60s, and one of the questions they ask each quarter of business people, are you planning to hire more or fewer people over the next 3 months? And the average reading for that is plus 13, a net 13% of businesses saying, hey, I'm going to hire more people in the near future. The June quarter result, minus 28%. Okay, that was pretty ugly. The most recent result, it's sort of now out of date, for the September quarter, plus 16%. September quarter already an above average level of intentions being revealed by businesses of hiring people. out there. And like I say, there's a few other indicators I could run through there. Increases in the number of consents being issued for new houses, up about 7.2% seasonally adjusted September quarter. There's a momentum out there in the economy. Forecasts are being revised, and what we have, of course, what was that yesterday from the Reserve Bank, starting to pull back on some of their maybe suggestion of negative interest rates there next year. The markets are starting to price that out. I don't think you'll get a negative interest rate there at all. But the Reserve Bank have said that they are now undertaking consultation with a view towards removal of the LVRs, reinstating the loan-to-value ratios from March 1 of next year. It's upset a few other people out there because the Reserve Bank promised when they removed them from April 30 that they'll stay removed until May 1 next year and then they'll reconsider. But hey, when circumstances change, you want to be flexible on your policy there. Now, of course, what I said for the media yesterday and a few others, well, this is going to be a feeding frenzy. Anybody with a low deposit is going to try and get in there before the things come back in from March 1. Well, I do think there'll be a feeding frenzy, but I think what's going to happen is what happened back in 2016. From October 2016, investors had to come up with a 40% deposit. But the Reserve Bank consulted on this earlier in the year and in late June, July said, well, we're going to reinstate the rules from October 1, but we would expect banks will respect or act on those rules now. So that's why whenever I've spoken about that 40% coming in, I've always taken July of 2016 as the starting point. Now, we already had the Governor yesterday saying the banks have been coming to him to suggest maybe the LVRs need to come back in because this thing looks fairly frenzied out there. So I do think that the banks pretty much straight away will be cutting back on their willingness to lend to the investors with the smaller deposits. And we're pretty much only talking about investors there. So leading into all of this, the proportion of money lent to investors with less than a 30% deposit was running at about 12-15%. It's over the past 3 months, it's gone something like, I think, maybe 25, 30, 37% of loans to investors in September were with less than a 30% deposit. For first home buyers, no change. It was basically 42% of loans to first home buyers had less than a 20% deposit for them. It's still that. So this is just the lending to investors side that really the Reserve Bank is looking to cut back on. Now, the Reserve Bank isn't looking to determine where house prices will go. That's not their mandate. In this regard, they're only interested in financial stability and the riskiness of bank lending portfolios. And so they just got a wee bit concerned that maybe the banks are just going a little bit far out on the branch there and leaving themselves vulnerable just in case after 3 months the vaccine starts turning us into zombies or something like that. And obviously, asteroid, watch for that first publication next year, just in case something new and bad will come along. Definitely, at some stage in the next 10 years, there's something truly horrendous coming along because every 10 years, something does. If you were to ask me, will we again, as you used to, will we again see something like the global financial crisis? My answer was always, well, yes, most definitely. No idea what, when, how bad, how long, but it definitely comes along. And so if you ask me now, could we ever see anything as bad as the global pandemic? Yes, most definitely, something in the next 10 years. Don't know what, when, how bad, how long. But you just need to keep that in mind when you look at maybe your debt exposure. And when you're doing your capital expenditure and rejigging your business, as we've all learned, you need to be pretty flexible. You need to invest in your digitisation over there, maybe some extra flexibility in your commercial property leases if suddenly you have to change your volumes in a hurry. If you can offload some of your commitment over there, might be quite useful. Anyway, that's a separate topic. In terms of the housing market specifically, why have house prices risen so strongly? I've covered most of the factors already, but let me just do a wee summary soon as I wrote this down for myself just earlier on. It's the interest rates being at low levels, motivating not just the first home buyers. For them it was mainly, I think, jumping into the market from June in a hope of listings. That's what they were responding to, a hope of listings. For the investors, it's more, the interest rates are so low, why the heck would I not do it, given that the banks are not going to give me much money on term deposits. Over the past year, the average 2-year bank fixed mortgage rate has gone from 3.5% to 2.65%. It's a reduction of 0.85% for 2-year bank fixed rate mortgages. For 2-year bank term deposit rates, they have gone down not by 0.85%, by 1.7%. That's how the banks are rebuilding their margins, their profits to offset the losses that they're going to be taking as a result of some businesses not getting through the COVID-19 shock. Just for your guide, there is extra downward pressure on term deposit rates, and it's going to continue to incentivise people to invest in residential property, to invest in commercial property, to flock towards commercial property syndications, to look for farm syndications and that sort of thing there as well. Maybe look at the share market or whatever. And just be aware, the Reserve Bank, they want asset prices to rise. In New Zealand, they're too touchy-feely and a bit too woke to come out and say, we hope our money printing and interest rate reductions cause house prices to go up. That was what the Federal Reserve was saying after the global financial crisis. We're printing money, we want asset prices to go up because there'll be a positive wealth effect on the economy. The Reserve Bank are happy with house prices going up, but they're not going to say it, not like most of us, not really happy at a 3.5% increase in 1 month period, but it's driving a positive wealth effect. Oh, I'm clever, my house price just went up. I'll go and buy a new golf bag or something like that is of relevance. But mainly they'll be happy with the fact that, oh, house prices are rising, I'll get something built. That connection there is very powerful, and they'll be very happy with that. So don't expect them to come out and say, you know, we'd like to see house prices fall. No. What I pointed out right from the start earlier on this year was, as a result of this crisis, the government doesn't want house prices falling, given the crisis and the election coming up. The banks don't want house prices falling, because they're used as security. Treasury and Reserve Bank don't want house prices going down. And most people don't want house prices going down either. There's only so many first home buyers in the market. Most other people in the market, they already own a house. Other supporting factors, I've mentioned the 10 billion, the 7 weeks of savings built up there. I guess we've learned that the pent-up demand, the frustrated queue of buyers, was phenomenally longer than we were thinking. I've always spoken in terms of, I think there's a lot of extra buyers out there, but they're just sort of thrown their hands up and gone, yeah, I can't see myself buying anything. But with hopes of listings, they jumped into the market pretty much from the May-June period. The listing shortage, it's a structural thing. The listing shortage will continue. I mentioned the job losses in services, predominantly, not all of them, non-homeowners there. The migration boom, untold people already in the country, and the LVRs removed. I've put that at the bottom of the list. I really don't think it's been a big driving force. It's become an interesting thing most recently with the investors, but I really don't give it a high weighting in terms of the housing market actually rising out of all of this. Where do I see things going from here in the economy? Well, I've already given a positive outlook when it comes to the residential construction sector and the way that spills out to just so many thousands of small, medium-sized enterprises all around the country, contractors, whatever, provides wonderful training, education opportunities for young people to do whatever they were doing there, to moving into the massively broadly defined sort of construction sector. And basically, if you've got a young person out of work at the moment, if they know righty-tighty and lefty-loosey on a screwdriver for screws, there's a job for them, basically. Someone is going to hire them and probably be willing to train them up at the moment, because the scope for house construction, townhouse construction in particular of relevance to Auckland, is exceptionally strong for a great number of years. And there's also a factor I haven't even thrown in here as yet. It relates to the migration boom, pre-lockdown, numbers low at the moment but starting to edge up. I would suggest every single one of in this room is of the view that there's 7 billion other people on this planet, and every single one of them right now is wishing they were a bloody Kiwi, maybe an Aussie, but they would like to be in here. And those 1 million expat Kiwi deserters overseas, sucks to be you. I bet you wish you were back here, and I bet you're going to be trying to come back here while the borders are closed, and then as soon as they're open, we're expecting the migration numbers to build up again very quickly. I think we overemphasise how many people will ever shift here. Doesn't matter. Our expectations of the future drive our behaviour now. We expect the migration numbers will get big again. It'll influence our decisions in terms of setting up retailing facilities, etc. around the country for more people coming through, purchasing a property, purchasing developable land, etc. Going forward. It has relevance there. Our expectations of a stronger economy will lead us to re-engage with our capital spending plans, our focus on labour saving technologies or all that sort of thing as well. Now, going forward, I think there's, like I say, 2 to 3 maybe more quarters left of spending the $10 billion and a little bit of next year's $10 billion we were going to spend on overseas travel. There's $160 billion worth of fixed rate mortgages which will renew in the coming year. and you're going to be rolling off your 5.5% that you locked in there down to what, 2.65%. I haven't worked out the numbers. Maybe at some stage I'll give it a go, but there's a lot of money going to be freed up for household budgets as a result of that. Going into all of this, household deposits in banks were rising at a pace of about 4.5% per annum. Okay, so that was sort of how they were growing. So people like me had an expectation of, by September, deposits of households in banks will be about 4% higher than a year earlier. They're 9.2% higher. The difference is about $10 billion. There's an extra $10 billion sitting in our bank accounts, also available for us to buy another spa if we want to, and maybe go overseas for a period of time as well. So that's sort of an extra insulating factor, helping of the economy going forward. 55% of our exports go to Asia, about 30% go towards China. China's economy is growing relatively firmly, with the Chinese government embarking on new infrastructure projects, etc., loosening up lending regulations for property developments. And as I say, the factories are busy making all the crap that we're purchasing at the moment and overseas as well. And this is positive for New Zealand, given our exposure to China. The fact that we're not as brash as the Aussies to be pushing back quite so obviously as the Australians are against some of the things that China's been doing there. I don't think we're going to get punished, as Australia is currently being punished with many of their different exports by China for the brash approach they have taken from a geopolitical point of view. So I've got a positive outlook there. And in fact, our export prices are pretty darn good. Sheep and beef returns might be down 20-25% this year, but the dairy sector is by far the largest, and you're looking at the analysts upgrading their forecast of the dairy payout for the season at the moment, so that's positive. I've already mentioned untold house building. Labour shortages, they're returning. That'll drive good job security. Again, it will keep us willing to spend money as consumers. The government will get some infrastructure work done, but by crikey, that's going to be interesting, because if you are in the infrastructure field, you sign up to build one of their shovel-ready projects, make sure you've got the ability to jack your price up in case you cannot get the labour that you want. And the time's stretching out, you definitely need a contract that gives you flexibility there, or you'll end up having to walk away from the whole thing. Like the builders of Transmission Gully basically were saying, well, we're going to have to walk away and leave this thing unfinished. We can't get the workers in from Malaysia. And so they got an extension, and some extra cash as well. And let me just finish off with, as well, I've sort of mentioned one or two here already. There's 4 things about which the next change in these things is conducive towards stronger economic growth. So the next change in business capital spending isn't more pullback, it's a re-engagement. It goes up. The next change in bank lending policies towards the business sector is an improvement. Slowly over time, banks are still a bit cautious, but the next change is that they'll become more willing to lend to businesses, and at some stage they'll be willing to lend for house purchase purposes to the self-employed and to people in hospitality, retail, tourism and entertainment as well, because they really don't want to know about those people at the moment. So that'll change also. The next change in the borders is an opening up. That's easy to say. They're closed. So there's sort of only, how do you close them more? Well, actually, many of us would probably like that, so less risk of quarantine leakage from the virus. But the next change will be an opening up, and of course, where most of us are thinking start of 2022. I wouldn't see 21, but I'm thinking start of 2022. And maybe I've already mentioned this. The next change in the wealth effect is positive. This is already underway. So when the share markets were falling away and the house prices we could see were falling for a while, the wealth effect, I feel poorer, I feel stupid, and so I'll cut back on my spending. Now I'm feeling wealthier. My shares have gone through the roof, whether it be my long-established portfolio or stuff I got on Sharesies a few months ago, for instance, and my house price is going up. Maybe I will spend some of that paper wealth as well. So that you've got these things also, like I say, contributing to an improved economic environment. Now, I could wrap it on. As I say, basically, I've got 3 hours in me. I'll just take the jacket off, get a bit cooler and go for it. But I'm going to knock it on the head there and just open it all up for questions, comments, and just see how maybe I can make it a bit more relevant for yourselves, or some particular point you'll be wanting to sort of get from an economist for some time and you haven't had one in your face for a while or so. So, any questions, basically?
Tony, how do you see inflation?
Inflation, no great worries about inflation, in that because there's still quite a few scared people out there, deunionisation in New Zealand and overseas, I can't see the wages pressure much as coming along to any great degree. What we saw as a phenomenon following the global financial crisis was that even in economies growing strongly, with job numbers growing strongly, wages never went up as much as was expected. And no one's yet developed the full answer as to why that dynamic between jobs growth and wages growth has changed post the global financial crisis. One reason, I think, is because there's been greater pushback against wage increases coming from the bosses, from the employers, the businesses. Now, why would that be? In the old days, you're running a business, if your costs go up, leasing costs, materials costs, regulatory, wages costs, you just increase your selling price. And if I buy your product, what am I going to do? And the cost to me of finding another version of the table I usually buy from you is I have to physically drive around the town, maybe I have to get to the yellow pages and call up other potential suppliers there. In the old days, pre-internet, the search cost of finding new information was high. Now the search cost, at worst, is basically zero. And the search cost is probably negative in that, for us, most of us, it is an enjoyable recreational activity to go online looking for cheap or cheaper stuff, if not crap. We go into Trade Me when we've got nothing better to do and hope we see another submarine or the spaceship-shaped chicken coop I think they had there. If anyone puts their price up on me, whatever it is, I will go online and I will look for something cheaper, and because I have confidence in my ability to use Google, etc., I will stick at it all evening until I find that manufacturer out of Kazakhstan who makes the same looking table and I can get it for sort of 20% less. I'll press buy now, I'll get the dopamine hit, and even if I have to wait 6 weeks, I'm stuck it to the man, that bugger that put the price up on me, I'm going to buy it. The pricing power of many businesses around the world as a result of the new technology, the internet, has gone down the toilet. And that was one of my key themes I'll probably start coming back to next year. It was there pre-COVID. And so the pricing ability of many businesses, I really don't see it's improved now with many more of us shopping online. So I struggle to see that inflation is going to really come back to any great degree in the future. Even when it does, the central banks around the world have said, we're going to let it rock for a while. They've actually explicitly said inflation's been too low, we want the average to be 2%, so we're going to let it go above 2%, if necessary, for a few years. So we end up with an average of 2%. They've signalled clearly they ain't taking interest rates up in any great hurry at all. So no, I've yet to have an inflation worry. And everybody who has had an inflation worry since 2009, quite frankly, has been wrong. Inflation's turned out lower than expected, except for Zimbabwe and Venezuela. Outside those two, we've been surprised every time. Where's the inflation? And that's why our interest rate forecasts have been basically all wrong since, well, pre-GFC, quite frankly. The inflation never appeared. We kept saying, oh, interest rates will go up. Oh, hang on, but the inflation is 2% lower than we thought. And the interest rates come down again. This is a structural change in interest rates in New Zealand and overseas. And as interest rates have structurally gone lower from the peaks in the late 1980s, as they first of all went structurally lower over 1992, it got factored into house prices. They went structurally lower, the mortgage rates, term deposit rates after the GFC, factored into house prices. This is the third and final big structural decline in interest rates underway at the moment. It's getting factored into house prices on a permanent basis. Sometimes I run through a list of long-term reasons why house prices have permanently gone up. I'll give another one there. Up until about 1995, 25% of houses in New Zealand were in the lower 25% of the price bracket. So here's the price bracket in your region, and 25% of the houses would be affordable down there. Since the mid-1990s, it's only been 5%. That's another reason why house prices on average are going up. Each year, the housing stock gets boosted about 1.5% by new houses, and you're not getting the new lower priced houses in there. Naturally, it leads to a higher priced housing stock. Just as naturally, we're going to see a higher rental in the rental stock out there because of healthy homes legislation, all these sort of things. We'll have better quality rental homes out there, but people are going to have to pay. From the government with its housing policy, they're smart enough not to set any great targets there, and I'd suggest they've pretty much given up on believing they have any ability to influence affordable housing, and I think they'll focus where they can and need to get some bang for the buck on the state housing side, and focus on the tripling in the numbers or quadrupling of the numbers in the past 3 years on the state house waiting list, for instance. That's just going to keep rising, basically rising over time. I think that's where the government will focus its effort. Sir?
It's kind of two parts to this. Do you see a correlation between the amount of money that has been injected into the system through quantitative easing and the increase in market cap of the New Zealand stock market? In other words, are we creating asset bubbles here?
Okay, so the first question there is about, with money printing, is it leading to asset bubbles? And I said earlier on, the money printing by the Fed that they were doing, they explicitly stated, we hope that this will lead to higher asset prices, people feel better, and they'll do some extra spending on the basis of that. It doesn't seem to have created an asset bubble across there at the time, and I'd suggest here in New Zealand it's not doing the same either. Our share market has pretty much risen, along with share markets overseas, after the initial 35% sell-off back over, I can't even remember what month the thing bottomed out, April or so. Here's what's happening with the printing money, and to talk about this, I first of all need to explain what printing money is. Here's the government. The government is running big deficits because their tax receipts have gone down with a weaker economy and their costs have gone up, paying people the dole, wage subsidies, all these sort of things. So the government's running deficits. The government finances the deficits by borrowing money, by issuing government bonds. And they can easily do that. New Zealand's got a great name. There's massive demand for the bonds that Treasury issues in order to finance the annual deficits that the government is running, as they should run when you've got this sort of thing going on. So no worries over there. But the Reserve Bank is a little bit worried because the more bonds that the Treasury sells into the market, the more the upward pressure on medium to long-term interest rates. Now, the Reserve Bank can influence short-term interest rates. I'm doing the shape of a yield curve here, floating, 2-year fixed, 5, 10, 15 years. They can control these interest rates here by moving the official cash rate. Further out you go along the term, though, they can't really influence it. And that's where the upward pressure will be coming from increased sales of government bonds. And the Reserve Bank is concerned that when the capital expenditure cycle kicks back up again, businesses probably aren't going to finance that new machinery at a floating rate. They're going to be wanting to borrow at these fixed rates out here. We want those fixed rates to be as low as humanly possible. How can we achieve that? The Reserve Bank will buy government bonds in the market by reducing the supply. What does that do? Improves the price, reduces the interest rate. So the Reserve Bank buys the government bonds. And if I'm a fund manager, a bank, or let's just say I'm an individual and I have got $1 million worth of government bonds, and I go, oh, the Reserve Bank seems to be offering a good yield there, I will sell them my $1 million worth of government bonds. And the Reserve Bank credits my account with $1 million. That's the printed money, the digital crediting of $1 million into my bank account. Now here's the key thing. I'm an investor. I'm not going to spend that $1 million. If I wanted to buy more fizz boats or batches or whatever, I could have done it weeks ago by selling the bonds on the secondary market. So I've simply swapped a bond asset for a cash asset. And the question is, what will I then do with that cash asset? You see, this is completely separate from government spending specifically over here. The Reserve Bank could have done this with the government running surpluses. Okay, what am I going to do with it? The evidence is the money goes absolutely nowhere. There is a tiny bit of leakage into spending, like real tiny. Some will go into residential property, commercial property, the share prices. Most of it goes nowhere. How do I know? On average, since 2001, I think that's the starting point I've got here, 2011, banks in New Zealand have on overnight deposit with the Reserve Bank $13 billion, okay, spare cash sloshing around the system there, and deposit overnight with the Reserve Bank, and they earn the official cash rate. In February, pre-money printing, the banks in New Zealand had $16 billion on overnight deposit with the Reserve Bank, not lent out to anyone. At the end of September, they had $47 billion on overnight deposit with the Reserve Bank. 90% of the printed money, it's gone nowhere. It's still sitting in the bond owners' bank accounts. And the banks go, well, we're not lending that out, and people don't really want to borrow it to a great degree at the moment, and so it just goes right back with the Reserve Bank again. So don't think printing money is money physically handed out, hyperinflation generating sort of thing. The lesson of the GFC was, or afterwards, was money printing doesn't do that. It ends up right back on overnight deposit with the Federal Reserve. I used to talk about their numbers. So that's sort of how money printing works. And yeah, the money isn't circulating. So no, I don't think it's a great contributor to any degree of, frankly, the rise. I didn't mention in my list there why house prices are going up or of the share prices. It's there, yes, but I think it's a pretty small motivator. Yeah. Seth?
Yeah, Tony, thank you for that. What's your thoughts around where borrowing rates will end up? I think there was an expectation they might continue to drop, maybe get to the 1.9s, and I know Harbour Bank, I think, did get up to 2% but does the unexpected buoyancy somehow change that expectation now?
Yeah, it does change the expectation, and we've already seen the swap rates, which banks borrow at to lend fixed, go up. I'm sorry, I can't remember, 0.35% over the past 24, 48 hours or so. Those rates have gone up. Now, not really in my weekly Tony's View publication, but the paid T-View Premium publication, $110. You'll get more than you can ever read. The free one is usually 6 pages. This one, I vomit everything I think of in the head. I vomit into this. It's usually 23 pages or so, like the one I sent out a few hours ago, into it. And in the interest rate section, I put the graphs showing broadly defined margins for fixed rate home lending. So I'll look at where the margin tends to average, whatever it is, 2.4% or so, and I look at the most recent swap rate, the minimum main bank fixed lending rate for the same term, and I can plot how the margins move. And so if here's your average for the margins here, blah, 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 they're low. And the margins have just shot down, generally as far as the low point. In other words, it's unrealistic, based on past experience, to be expecting the banks are going to do any more cut in fixed home mortgage rates. And that's partly why I wrote in both the weeklies there, why, remember, I'm a fan of 5 years fixed at 2.99%. Every man and his dog, like 95% plus, are out there grabbing the candy of 2.49% at 1 year or 2 year fixed. But it's candy and it tastes sweet. But if your desire is a longer term fixed interest rate, by the time the 1 year runs around, or maybe the 2 year, the risk is those longer term interest rates are higher. Not hugely higher necessarily, because the Reserve Bank is going to suppress them to some degree, but I do think the scope for further declines in mortgage rates is pretty much gone. You can never discount one bank going, oh, sod it, we're just going to cut and see what happens out there, and now and then maybe Heartland or TSB, for instance, will do that, but yeah, the margins, they're in the negative territory. And I publish graphs showing that out there. For the business, I don't keep up to date with the business lending rates, it's more individual margins and that sort of thing. Sir?
What impact do you see on exchange rates without interest rates being low? It's traditionally without exchange rates down.
Right. Okay, question about exchange rate. Interest rates low, generally Kiwi dollar goes down, where the interest rates are even lower in many countries overseas. My view for some time has been the Kiwi dollar trends upward, for a great variety of reasons. Number one, our terms of trade, export prices versus import prices, is at a record level. It's higher than back in 1973, so that's where good prices for our goods exports, sheep, beef, dairy, etc., and not paying so much on the other side for motor vehicles, electronic goods coming in. This is an exceedingly positive thing for New Zealand, and it bespeaks of upward pressure on the Kiwi dollar. We all expect the migrants are going to be coming back in, bringing maybe some money with them. There's maybe a bit of a correlation there, possibly in migration flows with the Kiwi dollar. The Australian Central Bank, was it last week, Melbourne Cup Day, they cut their cash rate from 0.25% to 0.1%. And now, this week, we've got analysts in the market in New Zealand going, I don't think they will have a negative cash rate in New Zealand. So the expected differential between Australia and New Zealand, it's changed quite radically just recently. And that's why the Kiwi dollar has actually taken a bit of a structural lift up, about 72.5 yen after being at 69 just recently. Maybe we're 51.5 against the British pound. All those poor Kiwis overseas there, hoping that the pound Kiwi's going back to 33 pence where it was. Geez, it must be about 18 years ago or something like that, or house prices will fall away. They're munted, which if you're not from Otago University means stuffed. Saturday night you get well munted, and then Monday night as well, this sort of thing there. So my view on the Kiwi dollar is it drifts upward, not at this most recent speed, but I think we drift upward over the next 2 to 3 years. Yeah.
New Zealand's not buying any planes either.
Not buying any.
No, not buying any planes.
Not buying any planes. Not going to need any planes for a while. No, that's right. Yeah, on the import side. Any questions over here? Okay, I'll look back. Any questions on this? Yeah.
Where do you see commercial property prices and yields going?
That's what Chris is going to talk about. Complete flick off on that question there. And when I was asked to do this talk, I was asked to residential, the economy and commercial. I said, whoa, hang on a minute there. None of us macroeconomists do commercial property. We leave it to these specialists. It's very specialised. Maybe in the interest of time, one final question, if there is one out there. No? Yes, there we go.
Shall I ask the politically sensitive question?
Ooh.
Do you see a Biden or Trump government as more advantageous to New Zealand?
I think Biden more advantageous for New Zealand because of a greater support for multilateralism sort of approach towards trade agreements, whereas Trump, he's used to the one-on-one negotiations. He goes for bilateral trade agreements if he's going to have any with individual countries, for instance. So I think broadly you'd say it's more positive for New Zealand. But when it comes down to these trade agreements, it's not very often over the years that a new agreement is signed necessarily for New Zealand to have a big impact. It accrues over the long term. It's more that we want to see a reinforcement of the strength of multilateral institutions, the World Health Organization, all these other ones out there. So generally we would view that, I think, as more supportive of New Zealand's longer term economic prospects. But I really don't think it sort of makes any strong difference in where our commodity prices go or exchange rate necessarily or anything like that. So I'm going to knock it on the head. You can go to the website, tonyalexander.nz if you like. You can sign up for the free weekly. If you want to give me a Christmas present, you can sign up for the TVU Premium. But just make sure you're aware that there is a lot of content in there with a focus on residential property market. Each month I dive deep into one region around the country to have a look at price trends at a suburban level, where they've got enough suburbs. I can look at where the prices are going, that sort of thing. Untold on, like I say, housing market, the economy general, and just whatever pops into the head when I'm talking to yourself. You might suddenly see me writing something down. It's because you've just given me an idea for something to write about. So look, thanks very much for coming along this afternoon, this evening, and enjoy the rest of the evening. Cheers.